Gloomy consumer sentiment is telling us to prepare for something very, very bad. Hey everybody, you're watching Bull Boom Bear Bust. My name is JJ, back with another dose of economic reality. Bull to the bust, BX4 back in the building. Ride the bull, prepare for the bear. Let's go ahead and get right into the economic news. We're going to get into the economic sentiment amongst consumers. It's looking very, very negative, and we're going to actually go all the way back to the mid-70s to show you a pattern of how consumers, people like you and I, the working class, can predict the next economic downturn. Will it be inflationary, deflationary, stagflationary? We're going to find out, but we're going to take a look at that chart. But first, a few things to get into before we get into it. A lot of layoff announcements. We got Boeing out there, cuts 4% of professional engineering union. That's Boeing. If it's Boeing, I ain't going. The union represents engineers and technicians, has 17,000 members at Boeing facilities who are largely based in Washington, with some in Oregon, California, and Utah. It's unclear exactly how many workers were laid off in each state this week, but we know the total is, looks like here, let's see, 222 members of its professional aerospace union. So we're seeing a lot of upper level management, engineers, technicians getting laid off. And a lot of times they'll cut in those areas before the front line, because the front line is usually dealing with customers directly. So in some cases you might see the white collar jobs and the office jobs, corporate jobs get chopped or get put on the chopping block first. And we're seeing a lot more layoffs. We've got Toro. Toro announces laying off 3% of its office staff globally. So again, not the people in the manufacturing facilities, but in this case, corporate staff globally. Another one, LL Bean lays off workers for a second time this year. We are seeing the unemployment rate tick up gradually, but we also see the labor force participation rate also going up here recently. But if you want to look at a visual on where the economy may be headed, let's take a look at what we've got here for you today. And here we have the University of Michigan Consumer Sentiment Index. And let's go back all the way to the 70s. We see a downturn in consumer sentiment followed by a recession. You see recession in the dark areas. Same thing. This was the early 90s. We fast forward to late 90s and the dot-com bust. Sentiment dropped right before the recession. That was the dot-com bust. So people start feeling it before it actually happens. Remember, it's usually declared by the officials and the experts. It's usually declared much later than what consumers actually feel like when it's a recession, when it's an economic downturn. We see the same thing, 2007, 2008, 2009 financial crisis, a drop right beforehand. And if you look, we even saw a slight drop prior to 2020. Now, it did go up, but in March, we saw the huge drop. Now, the huge drop there was after the shutdowns and everything else. Chaos evolved there in 2020. Recently, though, look where we're at. Over the past few years, we're down around the levels that we've seen during previous economic downturns. Take a look. Back in the 70s, 90s, financial crisis levels. Look at this. We're down at those levels right now. So are we in a major downturn right now? Just they haven't declared it. They haven't announced it yet. If you look at consumers, most consumers feel like they're in a downturn. Just because markets are going higher and stores are still packed doesn't mean the consumers aren't feeling the strain. It just means people are taking on more debt. And then when you look at the spending data, it looks like the economy is very, very strong because people are spending so much because prices are so high. And they use how much people are spending as a gauge of the economy. So as long as people can continue to run up debt on their credit cards, get new loans, etc., you're going to see the economy look like it's actually expanding and growing, but in reality, consumers are getting more and more negative. University of Michigan Consumer Sentiment Index points this out very, very well. Now, some of you may say, well, inflation is slowing. Why would everybody be so gloomish right now? Why would consumers be negative on the economy if inflation's slowing, folks. Inflation's slowing. Most of you know this, but I have to repeat it because a lot of people still don't get the concept. Inflation's slowing. It's not really helping anybody. It just means prices are going up just less quickly than they were going up previously. So when you compare it month over month, year over year, when you see the number dropping, it doesn't mean prices are dropping or the cost of living is dropping. Overall, prices are still going up. And that's why we need to look at this chart here. This is a cumulative CPI, Consumer Price Index chart. Not just the change from the previous month or year, but cumulative, if I could say the word. Let's go ahead and bring it up here. All right, take a look, folks. This goes all the way back to the 50s. And what's very interesting is we see a very, very gradual rise throughout the 50s, throughout the 60s, early 70s. What happened? Money became unleashed. No more gold standard, no more limits. And naturally, we start seeing this take off. And of course, we exploded. We're expanding the debts, deficits. But after 2020, notice the even steeper increase. And let's go ahead and zoom in on a 1-year chart. So what we're celebrating here with slowing inflation is celebrating that it's going up more slowly compared to previously, right? This steep line right here, let's look at a 5-year chart, right? See how steep it went up from 2020? We're celebrating the slight deceleration in inflation. That's what we're supposed to be celebrating. And then people are scratching their heads, wondering, okay, I still can't afford anything. Everything's too expensive. But they're telling me inflation is slowing. People don't understand it. They can't really connect the dots because of the way that it's being reported. What really should be reported, the proper way to say it would be prices are still going up. Things are getting worse, but they're getting worse at a slower pace than they were getting worse previously, right? Kind of a long way to say it, but that's the way you can really describe it, in my opinion. I mean, let me know what you think. How would you describe this inflationary situation where they're trying to say lower inflation is actually a good thing and lower inflation actually helps people, which it really doesn't. It's less worse, but it's certainly not good news. Unless you think less worse or the lesser of two evils might be good news. It depends on your perspective, but to me, it's bad news and negative. All right, now speaking of high prices, the cost of living, inflation, vehicle prices. Take a look here out of Wolf Street. We've got Wolf Street showing us a very, very nice chart here. And since the peak in early 2022, car prices have come down quite a bit. Not in a straight line, but they've come down. But look over the past few months here, actually throughout the whole year of 2024, they stopped dropping. And in fact, since about mid-year here, they have went up. Prices have went up. So what's going on? Well, we have a lot of dealers out there refusing to budge on their prices. They're buying overflow lots for their vehicles. And they know that as long as banks are giving out loans, they don't really have to drop the price that drastically. And what have we seen here recently with automobile loans? We've seen a lot of the loans being bought up by big Wall Street corporate money. And that's how, in this case, the banks, car loan companies can keep loaning out money because the debt, the loans get bought up as securities, as bonds. And when prices are very high and people can't afford the vehicles for the most part, you would expect a big surge in inventory. But what's happening? Inventory is actually not increasing, it's dropping. Look at this, folks. Used vehicle inventory at dealers in millions of vehicles. In 2020, at the beginning, it spiked up to 3 million. Folks, we're down to about 2.2 million. That's a significant decline, and it's very, very low. So one of the many reasons why prices aren't really crashing like a lot of people thought they would crash, you would think with so many people and all the levels of debt people are in and the prices being so high and unaffordable, that we would see inventory spike and prices crash, but we're not seeing that at all because of the way this whole thing is being engineered and manipulated. And I know I'll probably get messages and comments saying, JJ, look at the stock market, you're missing out. Folks, I'm not missing out. I'm still gaining some money in the stock market. My investments are still going up. I still have a retirement account. I have my personal account, my personal investment account, and my retirement account both going up. My retirement account, 401k, not going up as much or as big as if I had more invested, I would be making more. But folks, I'm being cautious right now. Take a look at a chart here. Look at the price to earnings ratio on stocks right now. It's the second highest of all time. The only thing that was higher than where we're at right now was prior to the .com bust in the late 90s, early 2000s. Let's take a look right here. The PE ratio, far right here, folks. Look at this. Here's where we're at. Here is prior to the .com bust. Even prior to the financial crisis, we were only down here at a level of about 27.3. Now, folks, we're at 38.5. The peak before the .com crisis was about 44. All right, so another piece of visual, what I would say evidence, that things are very, very overvalued right now. This market, price levels right now, home prices, housing market, stock market, pick your market. It's not based on fundamentals, folks. It's based on easy money and record debt accumulation, record spending, record lending and spending and borrowing, all of the above, folks. And prior to these enormous spikes in PE ratio in the stock market, that's price to earnings, there were people during those times as well that said this is going to go up forever. It's going to be hyperinflation. Will this time be the time where nothing derails it, that'll keep going up and that you better get into the markets, otherwise you're going to miss out? Or will it be like every other time where you're going to see something big come in, some surprise situation that derails the stock market and derails the rest of the economy, right? That's what I'm concerned about. That's how my mind is trying to process this. And I do see the risks being elevated, right? So make money, but be careful. That's what I'm doing. I'm not saying you should do that, but I'm doing that. Investments. What do you think about it, folks? Please let me know down in comments. What do you think about these charts today? Consumer sentiment at the levels now that we saw prior to several previous economic downturns. Is that an indicator? Price to earnings ratio in the stock market elevated, the second highest, only beat by the .com bust, prior to the .com bust, folks. So this is telling me we're very, very close. And I've been saying here the second half 2024, look out. January is around the corner, folks. I don't think we have much more time before we're going to see a big act of war, something shocking to throw a monkey wrench into the gears of this economy, right? So I want you to be prepared. I want you to be ready. I want you to make money, but also be ready, because you can make money for years, but one huge devastating loss, if you're all in on the markets, can really change things for life. So be careful, be cautious, but also make money. You know what I'm saying? So I hope everybody's good. Hope you guys like this report. Please make sure you have those notifications turned on so you don't miss a report. And as always, keep stacking. Bye for now, everybody. Peace.